You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. And now, it's time for the show that breaks down the options market. From unusual activity alerts to market analysis, strategy overviews, listener questions, and much more. If it involves puts and calls, then our all-star panel will break it down. It's time to hit the Option Block with your host, Mark Longo from the Options Insider Media Group, and co-hosts Uncle Mike Tussaw from RCM Asset Management, Andrew the Rock Lobster Joe Venazzi from OptionPit.com, and Mark the Greasy Meatball Sebastian from OptionPit.com. The Option Block is brought to you by Fidelity Investments. Fidelity's Option Trade Builder tool can help you confidently build an options trade in 3 simple steps. Just choose a strategy, select a contract, and then review the benefits and risks of the trade. Learn more about Option Trade Builder at fidelity.com/options. Options trading entails significant risk and is not appropriate for all investors. Certain complex option strategies carry additional risk. Before trading options, contact Fidelity Investments by calling 800-544-5115 to receive a copy of the characteristics and risks of standardized options. Fidelity Brokerage Services, LLC, member NYSE SIPC. And now, get ready to hit the Option Block.
All right, everybody, that rockin' tune means it is time to rock out once again with the Option Block. My name is Mark Longo from theoptionsinsider.com, coming at you live here, noon Central, 1 p.m. Eastern, for the Thursday edition of the old OB, as the cool kids like to call it, and hope you guys are enjoying. Seems like you are from all your feedback, all your fun stuff. Keep that feedback coming. We love to hear from you. Also, if you like what you're hearing, make sure you head out there, leave a review on whatever platform it is you like to listen to us on. It always helps attract a cadre of new listeners, which is always fun at the end of the day to see the new blood flowing in there. Speaking of new blood, let's see who we got. Got some old blood, got some mixed new blood, all kinds of blood on the show today. Let's see who we got. Joining me on the old all-star panel today. Let's start off. Let's go out to the quiet hinterlands where nothing ever happens. Yes, St. Charles, where once again I am joined by Uncle Mike Tussaw from St. Charles Wealth Management. Uncle Mike, how go things in the quiet hinterlands, sir?
It's quiet, at least in the hinterlands anyway, but a lot of action and a lot of things going on in the marketplace today, to say the least, especially where I live.
Yeah, a lot of things happening in Uncle Mike land. And also joining us from the actual hinterlands, he's pretty much on the fringe of these here United States. If he goes a few feet beyond his door, he's international waters. He's just floating in the ocean because he's the rock lobster. Coming to us from the options mecca known as Maine by way of OptionPit.com and Carmen Line Capital. Mr. Greasy, I almost said Greasy Meatball. I apologize. Mr. Rock Lobster, sir. What is going on in your neck of the woods these days?
I'm good. It is actually sunny in the 40s. Maine, the sunniest state that you never knew was the sunniest state. We get a lot of sun.
Maine, surprising mecca of a lot of things. Options, sunshine. Who knew? You know, I think Florida may take issue with that, as they are indeed the Sunshine State. And joining us in the Fidelity hot seat once again, you know him, you love him, the Song of Ice and Fire. He's excited to have his prequels coming. Mr. Colin Songer holding down the active trader strategy desk hot seat today from Fidelity Land. Mr. Song of Ice and Fire, welcome back to the program, sir.
Well, thanks for having me. Actually, I had our first bout of ice this morning with a little black ice to make sure to sharpen our senses when we drive. So pretty interesting morning. So got a little ice, not a lot of fire.
Our second guest in as many days from the other options mecca of New Hampshire. Who knew? Such a bustling mecca over there as we keep on rolling right on into the trading block.
It's time to break down the latest topics, trades, and trends in the world of options. It's time for the Trading Block.
All right, everybody. Let's see what's popping off here on the old Trading Block today. And, you know, it's one of those it's a weird time in general. If my voice sounds like it's a little bit teetering on the brink there, it's probably because it is, listeners. I've been fighting away at a cough and a cold for the better part of the last few weeks, but it seems like it's finally making its way to me. But I think I'll survive for a few more shows here. So nice to have a holiday coming up. Give the old vocal cords a bit of a break. But yeah, coming into showtime here today, you know, all this optimism, all this enthusiasm over the trade war, it was pretty much a done deal. All that had to happen was the I's had to be dotted, the T's had to be crossed. Well, it sounds like there were a lot more I's and T's than perhaps the market anticipated, because the last few days we've seen some downside as a result. And maybe this thing ain't happening. Now we're seeing maybe not even this year. So it's been a lot of back and forth. We were saying on the show a couple of weeks ago, this seems like a lot of hoopla for a deal that isn't anywhere near signed yet. So turns out we were right. Markets coming late comers to that party here, and they're selling off a little bit again today. Nowhere near as robust as some recent sessions. Today we're seeing the S&P and the NASDAQ. S&P actually, the Goldilocks yet again, off about 0.1%. The Dow almost unched, and the NASDAQ off about 0.2%. We're seeing gold coming off as well, and crude WTI at least getting a bit of a lift. We'll get to all that fun stuff, metals, crude, some equity, small cap, all fun stuff on TWIFO coming up in a little over an hour here on the network. But still interesting stuff. All this red on the screen means VIX cash getting a bit of a lift up to about 1360, which puts it up pretty much exactly a point from where it was on our last show. Now we're seeing it at about 13.25, so it's come off a little bit. That puts it up, you know, about half a point today, and up close to about 0.75 of a point or so, a little bit less on the day from our last show here. And our old friend VVIX also up. It's about 96.75. That puts it up about 3 handles from where it was this time last show. So back to Monday, all the way back to Monday. And our old friend VXX also getting a bit of a lift, threatening the 18 handle at about a 17.95 coming into showtime. Puts it up about 2/3 of a handle from last show. All right, let's go back around the horn. Let's go the way we started. Let's start in the land of Uncle Mike, sir. You said there's a lot popping off in your neck of the woods. What is lighting up your tape today, sir?
Well, first off, let's talk about the S&P. Yeah, we have sold off a little bit since some of the news has happened, but keep in mind we're roughly 20 points away from an all-time high in the S&P, and that's roughly 2/3%. So we're not even 1% off the all-time highs. So granted, for those of us that have been in the marketplace for a long time, I can remember a time when I first started that a 10-point move in the S&P was kind of a big, not a huge deal, but kind of a big deal. But now it's a 10-point move in the S&P. That's kind of like what a 2 or 3 point move used to be for some of us that have been around for a while. So with it, I think we just need to kind of keep things in perspective with where we're at. The market does seem to be spooked a little bit, but really not a large amount, I wouldn't say, based upon the fact that from a percentage standpoint, it really hasn't moved very much. In terms of some of the other things with which I'm watching, just looking today, silver, we're still around the 16 handle in the SLV, that is. XLF, the financials, it's a similar amount off the all-time highs. Technology is still up pretty high. So we've had a little minor, I don't even know if I want to call it a pullback. I would just call it a few down days. And by down, I don't even know if it's really that far down. So that's kind of my view on the macro market. I think we are definitely waiting to see. We're in a wait and see mode with the trade deals. And that's kind of where we're at in the macro side of it. The story that kind of hits me a little bit where I live is the deal or the announcement to where Schwab is buying TD Ameritrade, apparently. And so on there, that affects a lot of people that are in the retail trading space, and affects a lot of people that are on the RIA space, to where for the way with which RIAs work is that an RIA is typically, or a smaller RIA, I should say, is that it's somebody like me, basically, that has a group of clients, and they use 1, 2, or 3 different brokers to put the money in a brokerage account to manage their trades. So let's say, just oversimplified situation, an RIA, which is pretty much what I do, they'll find 4 different clients that they'll say, okay, I want you to manage my money, Mr. RIA, registered investment advisor. And of course, you have to go through certifications. You have to be legal, and there's quite a process for going through this to make this legal. But then those 4 clients, you feel that, okay, I think that broker number 1 would be best for this client because he's really into options. Broker number 2 would be better for this client because he likes to view his statements in this fashion, and this broker provides statements in this fashion. Broker number 3, he needs this type of technology to look at. On broker number 4, he doesn't like any of it. He just likes paper statements, and he feels that this broker would be the best fit for him. And there's infinite amounts of reasons that one broker may fit somebody over the other. I'm just kind of making those up as I go. But what has become very common is that in the olden days, a lot of times what would happen is that financial advisors would just work for a large company, and that's it, such as a Morgan Stanley, Goldman Sachs. But then as time went on, and people with lesser amounts of money, and by lesser I'm talking less than several $1 million, there became more of a need for smaller RIAs that were willing to work with clients with that amount of money. So because companies like Goldman Sachs would not be interested in having a client with a net worth of $400,000, a lot of independent RIAs came about to work with clients with that amount of money. And so because of that, Schwab as well as TD Ameritrade are both big players in the brokerage space for independent RIAs. And so it'll be interesting to see how this plays out with the consolidation that's going on in the marketplace. A few years ago, I believe it was 2016, TD Ameritrade bought Scottrade. And so now we're 3 years later, TD Ameritrade's being bought by Schwab. And combined with those 2 companies together, the new Schwab, TD Ameritrade, whatever they're going to call themselves, likely just Schwab, is going to have over $5 trillion of assets under management. And that's going to be huge. So curious to see how this plays out. The market appears to like this move because both companies' stock are up in value. And it's definitely going to be interesting to see where this goes, what this does, and how this affects not only the retail clients, which is what almost all of our listeners are, but also in the RIA space.
Yeah, I know we have some listener questions about this, so I was going to touch on it in the mail block, but you're right, it is kind of the biggest news in the space right now, so we could bump it up. We could talk about it now here in the trading block. I'll just credit one listener here, Mick James. Mick James asked, what do you guys think about the Schwab TD deal? Any impact on the options market? Well, Mike just kind of broke down the impact on the RIA space. From my own personal perspective, I've never been a big fan of massive leviathans lurking in any particular space, whether it's the exchange space, whether it's the brokerage space. I think we've all seen the benefits of healthy competition. I mean, the more recent example is the move to zero commissions, quote unquote zero. Obviously, it's not for options. Of course, there's some conspiracy theory even going on today that Schwab made this move to weaken TD so they can go after them at a more favorable price. I haven't had a chance to read the Bloomberg article, but everyone's hitting us up with it as that one as well. So maybe some Machiavellian scheming going on there behind the scenes. But in general, I think the end user, even from an options perspective, has benefited from, look at the arms race that has gone on in the option space over the past decade as brokers have fought for your dollar. what's happened is commissions have moved down, but more importantly, commissions are kind of just the low-hanging fruit. We've seen the platforms improve dramatically. We've seen the tools improve dramatically. We've seen the execution improve dramatically. Things that actually matter to your bottom line outside of just the surface things of commissions. These have all gotten markedly better because these brokers have spent tens, hundreds of millions improving their platforms so they could gain an edge for that bleeding edge of the options user. A lot of guys are fighting for you, the options user. They want you. You guys have higher education, higher income. You trade more. Every broker wants you guys. So they are fighting for you guys with better tools in this arms race. So to see one massive Leviathan come together, because you're right, TD is now Scottrade, you know, and they already bought them. Now we have Schwab, which has the OX. So we have OX and TOS all coming together from an options perspective. It's kind of madness right now. Again, this is still early days. None of this is decided. But in general, I've learned over the years to become leery of massive Leviathans popping up in the space because it usually tends to dial down the competition, which at the end of the day is beneficial to a lot of our listeners here on the network. Mr. Rock Lobster, what's lighting up your tape? And also, if you have a hot take on the biggest news story of the day, this deal, as Mick James is asking us, feel free, sir.
Well, I'll touch on a couple things that Tusaw said. We're not very far from all-time highs, and now we're kind of at this wiggly spot with the trade war. It appears that the impeachment thing is not moving the needle very much because, well, the market's at a near an all-time high and volatility is only about 1 point. VIX is only about 1 point off its lows of the year. So from that point of view, you're kind of sitting and you're like, okay, December 15th is the next day. So if you're a vol trader or you're like a decay trader, maybe we don't have a lot of action, or we're going to have news snippets between now and December 13th. Unless we get news, I don't expect much to happen. So you go back to kind of the fundamental stuff that drives stocks. Earnings were pretty good. And so, like, for just watching that stuff, it's hard for me to get excited to do anything like broader market-wise. That I feel like that type of trade has to have an end date past the 15th, later December. So, maybe vol gets a lot lower after that. Maybe we get a lot higher before that if there's more of an argument. You had this Congress passed, or I think the House and the Senate both passed bills about Hong Kong civil rights and stuff like that. Trump will probably sign it, I guess. So again, then the Chinese get mad and there's no trade deal. So there's a lot of current of uncertainty, but there's no really anything concrete. And I think that's why we have what we have right now. So I would characterize this as, realized vol for SPX is relatively low. It's a single digit, 5%, something like that. Volatility in VIX is like the mid-90s, somewhere around there at the money. The VIX cash is like 13, so the actual vol risk premium is pretty high right now. So you don't see a lot of vol in, let's say, necessarily in SPX options, although it is higher. But once you start getting to VIX and VIX futures and seeing the premiums assigned to those things, if right now, if you want to buy a VIX future for December, it's $15.35. So you got realized vol at 6%. VIX cash is $13.25, and then you're paying what I would call slightly above my kind of fair value number for where a VIX future should be about this point in the cycle historically. So you're paying a little more premium for a VIX future right here. It's not a ton more, but it's a little more. So, the whole complex, DESGen, Feb VIX, they're pretty freaking expensive relative to where the cash is right now. Not hugely, but I say they're about $1 more than at least the back month stuff is. So there is some premium in the futures. They will slowly melt, but it's hard to get, like, how do we get any real move in VIX cash unless there is a real driving news? Like every morning, it seems like it's kind of a little bad news, but there's no sell-off. We really can't get that sell-off. So I feel like it could be quite boring, and the orbit of how SPX move is going to be really tight between now and the middle of December. Like, it could be totally wrong because some other news could come out, but if the current scene plays out, I think that's what we have. So, I think the Santa Claus rally came a little early this year when the big fruit stock traded, $265 or more. Google is 1,300. I mean, a lot of stocks are pretty high prices. So it's hard to see what takes us higher unless we have some actual real news at this point. I never thought we'd get over 3,000 with the news we had, but the market apparently did like earnings, and I don't think any real bombshelly things came out of the impeachment. So at least for that, it somehow got past that, and now we're at this level. So that's what I'm seeing.
Thank you for that, sir. And Mr. Song of Ice and Fire, sir, what is the Fidelity Legion, the masses? What are they up to today? And also, if you have thoughts on this big news in the broker space, if not, I get it as well. You work for a competitor, so feel free to abstain if you want. But first and foremost, what are the Fidelity Legions? What are they trading up to today, sir?
Yeah, so we pulled up the orders by customers here at Fidelity. It kind of an interesting bag that we got this afternoon. So first one, topping the list was Aurora Cannabis on the top of the list, with 67% of the orders placed were buys, 33% were sells. It's currently trading $313. It's up 49 cents, which is 18.75% up. And this is based on a headline coming out about, I believe it was potential anticipated demand coming out. Now, it's below all its moving averages, but it has rallied to get close to its 20-day moving average, and it's pulled back above the lower Bollinger Band. The volume call to put ratio is sitting at, get this, 6 calls to 1 put versus its 90-day average of 1.94 to 1 put. So I would say a little bit more call attention being placed here with call paper. Next in line was AMD. I would say that it's starting to be a regular on our top 5 here. It's 50-50 with buy and sell orders. The headline that came out was based on Northland Capital downgrading AMD. It's right now trading at $39.29. It's down $1.70, which is over 4% down. And its price is still above its 20, 50, and 200-day moving averages. It did push out above its upper Bollinger Band, but it's pulled back within it. The volume for its call-to-put ratio is sitting about 1.25 call to 1 put. When you compare it to its 90-day average, it's actually 1.88 call to 1 put. So a little bit more muted. That's based on a little bit more put volume that we were seeing based on our option statistics page. In the number 3 spot, another interest was Canopy Growth hitting there as well. Same headline as Aurora on there about the anticipated demand. Now, this one did push above its 20-day moving average. It hit the 50-day moving average, but retreated back a little bit from there. The 20 is below the 50-day, and the 50 is below the 200-day moving average. But it has rallied to pull back within its lower Bollinger Band. Now, 63% of the orders placed were buy orders compared to 37% being sell orders. It's currently trading $20.73, which is up over $3 per share, which is, yes, about a 17.5% pop for today. When you look at the call-to-put ratios on this, today it has 2 1/3 call to 1 put, compared to about 1.5 call to 1 put for its 90-day average. But the overall volume, when you look at the options traded today, when I looked at this at around 11:30, it was already 3 times the amount of option volume when you compare it to its 90-day average volume. Now, in the 4 spot, hitting cleanup was Roku. Roku is another one who's been making almost a regular appearance in the top 5. It had 55% of its orders were buy orders compared to the 45% for sell orders. It's trading 156.24, which is down $2.69, which is about down 1 2/3%. This is based on, there were some headlines that come out about them putting through registration to sell another 1 million Class A shares. Now, with Roku, it's still sitting above all its moving averages, and it did break out through its Bollinger Band a couple of trading sessions ago, but it has pulled back since. So interesting to see that it is still trying to push on that upper Bollinger Band. Now, a call-to-put ratio is it's right now trading 2 calls every 1 put, when its 90-day average is sitting about 1 1/3 call to 1 put. And in the last spot, we have Macy's sitting in there. So Macy's had 62% of the orders placed were buy orders, 38% were sell orders. It's currently trading at $14.73, which is down 28 cents, which is 1.9% down so far here today. And this is earnings related. They did top estimates but missed on revenue and lowered its forward guidance. So the price right now is below all its moving averages, below its 20, its 50, and 200 day. And it is sitting on that lower Bollinger Band so far here today. It hasn't broken through. It did kind of pierce it, but it pushed itself back above that lower Bollinger Band. And the call-to-put ratio is actually 1-to-1 so far here today, compared to its 90-day average of being 1 1/3 call to every 1 put traded. So that's what our Fidelity customers have been trading here today. And, in terms of the big news that came out here today with brokerage firms, it's going to be interesting to see how this kind of works itself out. With them being a competitor, there's really not much that I can say. But I do say that I do agree it is interesting just in general. The more competition that's out there, it's only going to be better for everyone. And that's just more of a general statement in sense. But outside of that, not much that I can't comment on that.
No, that one's not up your wheelhouse. I get it. But you're right. It is interesting to watch these early waves of potential consolidation. There aren't that many players left to consolidate. Most of the consolidation seems like it's taken place, but maybe we'll see another wave now that this race to zero, at least on the equity and ETF commissions, has begun again in earnest. Let's see what the broad market is up to today. We mentioned kind of a bit of a meandering day to the downside. Most of the major indices doing some paper, but not a ton. VIX, once again, light on the paper side, 185,000 contracts coming into the tail end of the trading block here. The ADV has grown a bit. It's threatening 400K to the upside again, but not quite there yet. Much better than the 330 odd it was at the tail end of last week. SPY at about 1.5 million contracts. The ADV is nearly 2.5 million. The S doing 557,000 contracts. The ADV a little bit north of 1 million. The Qs are actually where the action is today. 485,000 contracts. The ADV nearly 500,000. So pretty much right there already. And the Russell, a.k.a. IWM, doing about $1.25, and the ADV is a little bit shy of 300K. Let's go on out to the most active equity options, see what's lighting up the tape out there today. Cost you about $1.19 to break into the top 10 today. That gets you to Uber with 119,000 contracts. Also, no, actually, it's a tie. I take that back. We'll get to the other one in a second. Number 9, Facebook. 133,000 contracts on the tape puts them in the number 8 category. Then we've got ACB, which is what Mr. Song of Ice and Fire was just talking about. Good old Aurora Cannabis at a whopping $3.15, or up a half a buck. They are at number 8 right now with 142,000. So apparently everyone, not just the Fidelity clientele, but everyone's loving themselves a little ACB. Number 7, Tesla. with 143,000 contracts. That puts them, again, at the number seven position there. Number 6, we've got Macy's. Interesting. It's been a big week for retailers. Target lighting it up. Macy's apparently doing some business here as well. It's off nearly 2% today at about $14.75. That's not going to stop them from taking the number 6 spot with 157,000 contracts. Number 5, Roku. $1.74. Roku's kind of a perennial top tenner now. Number 4, Twitter at exactly 200K right now. Number 3, Canopy Growth. Sector just keeps on giving. That one's up 17.5% today to about 2075, and it's good for number 3 here on our top 10 of 256,000 contracts. Number 2, some company I never heard of, Apple. I don't know what they do. 376,000 contracts for them. And number 1 with a bullet, again this week, knocking Apple out of the top spot. AMD, 463. AMD and Roku are kind of these names. Who would have expected so much volatility and volume coming out of these two? Yet they're delivering these days here. We also saw some delivery on the earnings front. I think we'll get to some of that if we have time in Around the Block, because now it's time for us to keep on rolling into the Odd Block.
It's time to break down the most interesting, unusual, and downright questionable options activity that's been identified by theoptionsinsider.com. It's time for the Odd Block.
All right, everybody. Let's get weird. Let's get wild. Let's kick things off. I knew that ticker seemed familiar because we were about to have it parsed up, teed up, ready to go in the Odd Block. Yeah, we're going to kick things off in that wild and woolly sector of the cannabis side of the fence. Mr. Rock Lobster, do you recall a week ago on this very program where we detailed someone coming in and playing with a whole heck of a lot of fire, it seemed like, in Canopy Growth last week? Do you recall this trade, sir?
I do, but I thought that, didn't we feel like this was a sale, like they were, or am I wrong on that one? Like some kind of buy ride?
Yeah, it definitely had the whiff of someone overriding. Let me break down the trade so you know exactly what it was. Dial your Wayback Machine all the way to a week ago, listeners, on the show, the Thursday edition of the Option Block last week, where we profiled someone coming in on the CGC Nov 15 half calls. So they had effectively a day to go. This was a daily at this point. Blasting away, it seemed like, at 4,656 of them. It was a pretty tight execution, 37 at 38. They were hitting the bid for size, so it seemed like they were probably selling that bad boy. This was opening over there in the NASDAQ options market. This was in the immediate blush of post-earnings. It seemed like, I think they had earnings, I believe, that morning. So this was right after the earnings. Someone coming in saying, hey, someone's 37-cent bid for those 15 half calls sold. And this is kind of what we mean, listeners, by playing with fire. This guy was playing with a lot of fire. It looks like it worked out for him, but he had to sweat it a bit. And if he had decided, I'm going to go out a week, I'm gonna get an extra week, maybe get a little bit extra juice for my premium. So instead of selling a daily, I'm gonna sell a daily plus a week, so a week and a day. He would have got his face ripped off. That's what I mean by playing with fire here. Because this guy, the stock closed. He sold these at 37 cents. Stock flirted with that 15 half strikes. That's what I mean by this guy was sweating. Because it's always fun when you're short premium and the stock is flirting right there with the at the money strike there. But it ended up closing 15.33, so shy of that 15 half strike. Digging into some of the paper, it looks like someone, probably our friend here, bought back some of them near the close. Saw a block of 500 going up for a penny right near the close. Didn't buy back all of them, but total of about 2,400 of these traded on Friday, so roughly half of the paper. Looks like that's not all him. Obviously, other people were trading these things as well. So looks like he probably closed some, but not all, which is an interesting approach. I guess he decided towards the end of the day he was good. So it looks like he sweated, but he ended up coming away with about $172,000 for his. I mean, again, he paid a penny for some of these, so probably a little bit less. We're on $170,000 with all is said and done. And why I say this was playing with fire, because if he had waited until today, the stock was over $21 this morning, 21.30. These things would have been about $6 in his face. And so instead of being up $1.70, he'd be down, about $2.5 million right now. So it's a dangerous way to make a living, Mr. Rock Lobster. It certainly seemed like it worked out for him in this capacity. But this is why we always counsel A, against earnings trading, and B, against crazy. And this appeared to be naked. He could have had a stock leg against it and other things, obviously, but it appeared to be naked overwrite. And if it was indeed, this is why we counsel against this kind of thing all the time, Mr. Rock Lobster. Because if he decided he wanted a little bit more juice, he wanted to go out one more week, Mr. Rock Lobster, his face, his house, everything else would have pretty much been ripped away, sir.
There would be not much left of the face. It would be a total face ripper. So anyway, I would say buying those back. Yeah, I figured there might have been like some kind of right, like a 1 to 2% right, but that would be an aggressive sale under any circumstances, especially in a stock that has some volatility. The pot stocks. I mean, I know they've been kind of on a one-way trip to Palookaville for a while, but there's still some volatility there. So anyway, yeah, you know what? Nobody went broke buying back a short option for a penny. I know that for sure.
No, and it seems like he had a little bit of that wherewithal. It seemed like some of them got bought back, but it could not have been him, obviously. It could have been other traders, but just crazy, crazy, however you want to think about this. This reminds me very quickly of a guy who used to stand next to me back in Intel back in the day. And right after expiration, there was, or right around expiration Friday, going into the close, there was, pretty much a cabinet, which was the lowest bid you could have back then for some a little bit out of the money calls popped up in the book. And also I saw that they were gone. And I turned around next to me, and a guy who was an old timer who had been around forever, was smiling at me and holding up the ticket. He had sold them, and he made whatever it was, $5,000 for doing that, something like that. And I just looked at him. I said, you have kids. You have kids in college. You have a house. You have a mortgage. This thing ticks up in the after hours for whatever stupid reason. There were other earnings coming out. Microsoft, I think, was reporting that night. Intel and Microsoft tended to move a lot together, particularly back in those days, back in the late go-go 90s. I was like, all that's gone for your stupid $5,000. And he was so giddy to show this face to ticket to me and how excited he was to sell these things. So it ended up working out, I think, for him. He kept his house. But this is another trade that kind of reminded me of that very, very much. Let's go on out to some others now and see if we can find saner heads. Of course, the odd block not the place really to look for sane heads, but we'll see what we can find nonetheless. Let's go on out now to, I believe this is a newcomer. This ticker doesn't, I don't recall discussing this on the odd block before. This is Northwest Bankshares. This ticker symbol NWBI, pretty much unched on the day, off slightly, about a dime, really. Not a crazy day for them. Let's look at the year and see how it's been for NWBI. Oh, it kind of looks like a nice little range-bound name. A year ago, it was trading a little bit north of where it is right now, about 17 and a quarter. Got up to about almost $18, not even. Then it sold off down to, let's see, how low did we get in the dark days of Christmas Eve? We got down to 15 and three quarters, and then right back up by February, up to 18 and a half or so again. Then it sold off again. I think you know this story, 16 and a half, back up to 18. And a lot of bouncing around in that kind of tight range. It sold off again, 15 and 60 back in early September. And then right back up by October to 17 and a half again. So it's been pretty range bound, which I know for a certain segment of our audience likes to harvest that premium in there. This has seemed like a pretty reliable player over the course of the last year. And ever since October, it's kind of been trending back down to where it is right now, 16 and a half, which brings us to where we are today. What did our Eye of Sauron find today? And again, it's kind of a light day, so not a lot of size prints going up, but a few interesting ones. Let's see what we got here. We've got, first off, a funky market on these. These are pretty wide, 25 cents wide, which is kind of what you find when you start going out beyond the Apple front month at the money options out there. We've got these May, all the way out to May 17 halves, going up for 27 and a half cents, 3,822 times. Another one on the box. Getting a lot of box prints on the floor these days. The trading floor of the box. Someone coming on the bid. Excuse me. These were 20 cents at 45, so pretty wide as you might expect in Northwest Bankshares. They have earnings, but not until the 21st of January. Clearly, there's going to be some earnings between now and May, a couple of cycles at least. So not exactly an earnings trade. Mr. Rock Lobster, this one kind of weird to parse. It's a spread you could drive a truck through, so reading into the execution isn't all that helpful. It's a longer term one, but it seems like it has a whiff of, let's see, 17.5. Looking at these levels on this chart, it seems like a decent level. It topped out for the year at 1881, so a little bit north of that. This guy's getting out pretty much if he gets his stock called away, or if he gets around 17 and 3/4 or so, which is about a buck shy of the all-time, at least not all-time, but 52-week high here. So a decent level, not a bad level, not a fantastic level either. Does this have a whiff of a covered call that doesn't really blow your skirts up to you as well, sir?
This has I would say it has more than the whiff of a covered call. It's one of those free money, where, okay, if it gets there, it's like, it's the giddy price call sale, right? Where it gets up there, the person's happy, they'll take the extra money, and that's clearly not a problem at 17.5 for the little bank stock.
Yeah, he's taking what juice he can get out of a name that isn't sexy. It's like I said, it is a range-bound name, so it is kind of reliable from a premium, right? He's going out a little bit. He's going out to May, so he's tying up some capital for that 27.5 cents he's getting. So maybe we'd like maybe a little more juice or a little bit less time, one or the other, but kind of hard to find those in these not exactly sexy names. That's probably why you have to go out that far to begin with. So yeah, looks like a standard overwrite. I don't think we're going to be putting this in our to be watched category, but if you disagree, listeners, if you're a big fan of Northwest Bankshares with a C, let us know. Let's go on out now to our final name. Here's the name we've talked about before. Frequent offender here on the odd block. This is NRG. Energy. Let's see. Ticker symbol, appropriately enough, NRG. This is one that's kind of had a decent year, some movement, a wee bit of movement. A year ago, it was trading almost exactly where it is right now. It's at 39.10 right now, off about half a buck. And a year ago, it was trading 38.16, so about a buck lower. And almost immediately rallied up to about 42.25. And then, of course, the great nadir came, and it sold off again to 36.25. So sold off looks like about $6 or so. And then it kind of bounced right back up. By the time February came around, it was back up to about 42.5. And it kind of hung out there for a while, looks like until April. And then it started selling off pretty hard. Into May, it was trading 33.75 again. So it sold off pretty hard there. Then it kind of hung out in that level again, 33 range into August. By late August into September, it had rallied back up to 39. And kind of where it finds itself right now. It's been hanging out in this kind of level ever since, bouncing around the upper 30s, low 40s. So let's see what we got ourselves here today. Well, looks like we got kind of a bit of the opposite, Mr. Rock Lobster. We were going out before and selling calls. This time we're going out, but much farther, and we're buying puts. It's looks like the NRG Jan 2021, 37 puts, going up 3,500 times. Someone lifting the offer. They were 340 at 370, so fairly wide, as again you would expect for longer-term paper and a not exactly a hugely liquid name. Lifting the offer, 370 for 3,500. These were crossed as well. Interesting. I love this new data we're getting, Mr. Rock Lobster. So someone coming up and maybe going up to a desk and saying, hey, I want to buy these. Anyone want to sell them? And they found a counterparty perhaps, or maybe the firm. Again, I would love that little bit of extra detail. Firm, or if it's an actual counterparty. Maybe a little bit of both. Maybe the firm took up the balance they couldn't get done. Obviously, brokers have an incentive listeners to shop these because they can get double the commissions, which is nice to get paid twice for the same work. So plus these things are kind of less liquid, so it helps to get these things done. So 3,500 looks like, Mr. Rock Lobster, we got someone coming in and looks like wanting to hedge a long way out at that 37 level, which is pretty tight actually. That's a decent level. Paying $370 for the privilege, and it appears like maybe we've got someone else saying, "Oh yeah, sold to you, sir." So what's your take here on someone locking in some protection here for a while in NRG?
Is the energy, okay, so I'll ask this, like, why bother buying puts in utility? I guess that's my question. Like, what'd you buy the utility stock for in the first place? Like, what, you know what I mean? Like, why bother buying puts a year out? I mean, I don't get that. I mean, I get it. I mean, I see the thing, I see the why, but why? Like you're just taking the low anyway. So I guess it makes you happy. I prefer the option to actually have to perform a function than just kind of get me to where like an all-time low or, I would use that option as a hedge against something. But the problem is like, what would you buy against that you could actually make the $3.70 work? So that's kind of a head scratcher to me, to be honest. Like why do you buy that put? You buy that put because you think the energy company is going to just get smoked, and hit some new lows. And that's certainly possible. So I would think it's more somebody's like betting on a long-term decline than really hedging an equity position. That would be, I would think that, but I can't see any other reason for why you would want to buy that put, to be honest.
I think you said it all. I get the why, but why? I think we could say that about a lot of our trades as we keep on rolling into the Thursday mail block.
It's time to take your seat on the All-Star panel as we read your emails, tweets, Facebook messages, website comments, and much more. It's time for the Mail Block.
All right, everybody, time for your Q's and our A's. And we also like to kick things off every week, getting to the heart of what the Fidelity crew, what the Fidelity clientele is up to, what they want to know with our Fidelity question of the week. And Mr. Song of Ice and Fire, sounds like they got a good one this week. This is a question about a position that I like a lot. We talk about it a lot on some of our other shows. I don't know, on the OPR show, they refer to it as a fig leaf because you're partially covered. Why don't you break down, sir, what this position is and maybe some of the questions you're getting from the Fidelity clients this week, sir?
Yeah, it was a question we actually based it on. We did a diagonal calendar class about, I want to say 2 weeks ago. And then we had a covered call class the next day. And the diagonal, or fig leaf, or leverage cover call, or whatever way they want to call it, that question popped up. And then we got a couple of phone calls on it. So I started seeing a reoccurring theme. So in essence, the conversation that I had with a client on a one-on-one basis was discussing about, if I do this approach, and I'll just use an example. If I bought a Leap 100 strike call for $10, then I will sell a 2-month out 105 call for $2 for simplicity's sake. Now, the thought process is that the 100 strike is basically going to be simulating my long exposure of long shares because it's going to be in the money. And the theory, and then I stress theory, is that I'll sell these shorter-term calls, get that accelerated time decay, bring in that premium, all sell as well. It'll expire worthless, and I'll just keep doing it over and over again. Eventually, I'm going to bring in more premium than what I pay for this Leap call that I have. Well, what people forget to plan about this is that initially when you open up this particular position, you remember you paid $10 for that Leap. You only receive $2. Now, you do have the $5 appreciation between the strikes. But in essence, you still open this up for $8. So even if you're right directionally in a short period of time, in that 2-month time frame, you still lost if it goes too deep in the money because those shorter-term calls have larger gamma. In other words, it is going to accelerate and give you a larger delta exposure faster. So in essence, with this type of spread, you can actually have risk to the downside as well as the upside. So you want to make sure when approaching this trade, you want to be aware of where those risks are so you can appropriately plan an exit to the downside as well as the upside, because you can't get caught on the trade. And that's something that you want to make sure where the risks are in any trade, even if you are trying to take advantage of that accelerated time decay with those shorter-term contracts.
Yeah, this is a popular strategy. Obviously it involves the leap, which is kind of a stock substitution leg, which is attractive. And then if you have stock or stock substitution, then the next logical step is to turn around and try to finance some of that with some, shorter duration premium harvesting. And as you pointed out, the plan, if all goes right, is to pay for some, if not all, of that long-term call by the time you get out there with all those short terms. But you're right, there are some nuances to this, and it's not exactly an intuitive position for a lot of people to wrap their heads around, but it is a popular one and a fun one. You're right, it has 8 million names. I used to call it a synthetic covered call, but that's not really right. Fig leaf, it's kind of silly, but it's not really. It's you can call it whatever the hell you want. It's got 8 million names, but the truth is it's a popular one. Mr. Uncle Mike, I think we talked about this before. Is this a position you like to utilize? You do a lot of long-term stock substitution, A, and then B, if you do you like to finance it with some near duration? And what do you think about some of these maybe secret or unknown risks of these types of positions?
The secret unknown risks are very secret and very unknown because until someone actually experiences it. I've had people call me when they've been in this trade, the market goes their way, and they're too right, if that makes or they weren't right enough, whatever way you want to put it, in that the market goes beyond their short strike, and then they end up losing money on it. And so on this strategy, it's a good strategy, but you need to have you need to be very active. You need to monitor it very closely. Over the course of the last 4 or 5 years when I do this, one of the things that I like to do frequently, not every time, but very frequently, is to sell a short-term call spread against it. So that way, if the stock just rips up to the high heavens, if you're doing calls, or rips down to the depths if you're doing puts, then you're buying some junk, so to speak, by buying that out of the money call, but you're still essentially having that effect of having that call and selling premium against the long call. By doing a call spread in lieu of a call, then in case it does rip up, you have some peace of mind knowing that you'll get to rip up or rip down with it. And so that's probably the main modification that I like to add to it. And that's my take on it.
Yeah, it's a weird one because you're right. You can't, if you're wrong catastrophically, obviously the stock drops against you. That's bad. But also if you're right too quickly, right too much, it's not good either. It's a weird one. You need a little bit of a time for it to percolate. And that's an interesting point about the put side too. I'm trying to think. I don't think we've ever discussed doing this on the put side before. It's not a very common use case to go that far out with the puts and then sell the near-term one, but it makes sense against an equity position. That might be a worthwhile thing to explore for a future episode. I'm going to table that. It's a good suggestion, Uncle Mike. As we keep on rolling into our final segment, it is time to go around the block.
It's time to tell you what we'll be watching on our trading screens until the next episode. It's time for Around the Block.
All right, listeners, an otherwise quiet day. There is a lot popping off, not just in the brokerage space. Obviously, there still are a lot of earnings going off. We had Home Depot, Kohl's, and Urban Outfitters, pretty much all the retailers this week. That was just Tuesday, Wednesday. Target, Lowe's, Lazy Boy, and the parent company of Victoria's Secret, so L Brands. Thursday, we had Macy's and Nordstrom and Gap, Williams-Sonoma. Today, you got Foot Locker. It is funny how these patterns emerge in earnings season as it goes along for a while, and similar names tend to coalesce together, which is interesting in and of itself. So still a lot of big names popping off. Again, I encourage you, if you're interested in all that stuff, we got the earnings move and earnings move results reports for you all there, free of charge, theoptionsinsider.com. Click on that options news and articles tab on the top right corner of the homepage, and you'll see it all right there, as well as all the other great content we have waiting. It's not all just talking here. There's a lot of great written stuff as well. So theoptionsinsider.com is the place to go. Let's go back around the horn. Mr. Rock Lobster, sir, what is on your radar for the rest of this week?
Just to see if my boring as hell thesis can still maintain itself, because we're caught between trade deal, no trade deal, Hong Kong. It's a morass of nothing. So I wish I had more to say, but I don't see a whole lot going on. Although I am looking for some value stocks, just really bizarre names. Looking for some nat gas names. And other ones, I don't want to mention here, but stuff that the market's kind of left behind but seems to be doing well. So, that's it. When the broader sexy stuff really isn't moving around and ball's kind of dead, I don't want to add a whole lot more of that. And I'm just waiting to see if something else is going to move.
Mr. Uncle Mike, same question for you, sir. What is on your radar for the rest of the week?
A morass of boredom. That's very interesting. Just watching to see if we can recover from the mighty 0.2% pullback that we've had. Wanting to see where things are. I am not at a point to where I want to start buying more by any means on that. Markets would need to go down a lot more for that. But looking to see that. All-time highs are the main focus for me. And continuing to watch what's happening on a macro level.
0.2%. All these names are becoming value plays again. Let's just gobble them all up. Value. Deals galore out there on the street. Last but not least, Mr. Song of Ice and Fire, what is on your radar for the rest of the week, sir?
Yeah, and it's pretty much the same. Focusing on trade deal. When I say trade deal, until they actually sign it, I'm still waiting for that to happen. But it's definitely another wrinkle with the Hong Kong developments. What's going to be going on with that? Interesting enough, I'm still watching gold and silver prices. It's still a very interesting level that they're sitting at. So that's something I'm going to be kind of watching moving forward still. And on top of that, what's been going on with the S&P? I mean, we're getting 3 days down from here, but before that, it was kind of a continuous thing of all-time high. Oh, wait a minute, a little so up. Nope, all-time high. Kind of seeing that development within on the chart there. So it's going to be interesting to see how the S&P deals with. Are we going to create a new all-time high, or is this uneasiness or this little pause? Like I said, it's pretty tough to call it a sell-off because there's not much of a pullback. But it is to kind of see an ease of day when we've had those up days. But that's what's on my radar.
Yeah, not quite a sell-off yet. Not quite there yet. But listeners, that music means, unfortunately, we are there at the end of the show. But don't worry. You don't have to go home if you don't want to just yet. Say I need a little bit more in my life, talking some more vol, some more skew. In equity vol, we're going to do some small cap as well as metals and maybe some who knows what's going to be on the show this week. You got to run the numbers and see. Maybe we're going to do some crude. Maybe we're going to do some rates, some ags. You never know what's going to make it on to join us for TWIFO in exactly half an hour. We'll be breaking all down with the return of Mr. Dr. Vicks. Mr. Rhodes joining me on that program today. Talk a lot about of futures options vol, so that should be fun. But before we get there, let's go back around the horn and see what everyone else has cooking for you. Let's start Mr. Rock Lobster, sir. Let's go back that way. If I'm intrigued, maybe I want a newsletter to tell me about what's going on in the vol space. Where should I go? What should I do?
Yeah, the vol newsletter, optionpit.com, volatility newsletter. Our subscriber base grows every month, so people like it. And if you want to learn how to have the market pay for your index juice, come to my weekly webinars, and you'll figure it out. So it's a nicely priced subscription at $6.97 a year. Usually, you can get just one trade pays for the whole subscription. Anyway, there you go, optionpit.com.
There you go, optionpit.com. Sign up for the newsletter, make the man happy, and then pay for your volatility trading for the rest of the year. Mr. Uncle Mike, sir, if I'm intrigued by these markets, maybe I want someone to explain to me the nuances of these long-term calls versus short-term calls or other fun things. Where should I go? What should I do, sir?
You should go to stcharleswealth.com to contact me, because I like to do a lot of long-term calls versus short-term calls, and I even like discussing them. If there's any questions on it, feel free to reach out to me. We'd be more than happy to have a conversation with you.
And Mr. Song of Ice and Fire, if I want to go to some of your webinars, maybe I have these questions myself. Maybe I'm a Fidelity client, or maybe perhaps I'm not, and I want to become a Fidelity client, so I could ask you these types of questions directly. How do I begin my journey over there at Fidelity, sir?
You could always give us a call at 877-907-4429. Certainly we're here to help you out in any way that we can, whether it's a one-on-one basis. You can always ask to speak with a trading strategy desk, or even ask for me. I'd love to be able to have a discussion with you, even with discussion on diagonals or the leverage cover calls, whatever you want to call it. As well, check out our website, fidelity.com/options. It breaks down the different tools to help you analyze your trades. as well as the services and educational resources available with our online classes that our desk teaches, as well as myself, as well as all the webinars and online content that you could use to educate yourself about option trading.
There you go. Fidelity.com/options is the place to go to begin that journey. And then once you kick the tires over there, you can call up a guy like the Song of Ice and Fire or the Last Emperor, all the rest of them. Ask them these questions directly, maybe take a class or a webinar, play around with the tools, all sorts of fun stuff. But Fidelity.com/options is the place you got to start. And on behalf of the Song of Ice and Fire and the Rock Lobster, Uncle Mike, and indeed myself, I want to thank all of you for downloading, streaming, subscribing, for joining us on this program today. Like I said, if you need more in your ear hole, stay tuned. About 27 minutes, I'll be back. These guys are done. They get to go off on their merry way, but I'll be back in about half an hour with the Dr. Vicks to talk all things small cap vol as well as a lot of the other vol popping off in the commodity space. It should be fun. So we'll see you back here in about half an hour. Then after that, we'll be back again tomorrow to talk a lot of vol on volatility views. And then, of course, we do it all again on Monday with actually our final OB of the week. So stay tuned for that one. And we'll see you back here in about half an hour for TWIFO, and then back tomorrow for vol views. And we do it all again on Monday for more of the Option Block.
The Option Block is brought to you by Fidelity Investments. Fidelity's Option Trade Builder tool can help you confidently build an options trade in 3 simple steps. Just choose a strategy, select a contract, and then review the benefits and risks of the trade. Learn more about Option Trade Builder at fidelity.com/options. Options trading entails significant risk and is not appropriate for all investors. Certain complex option strategies carry additional risk. Before trading options, contact Fidelity Investments by calling 800-544-5115 to receive a copy of the characteristics and risks of standardized options. Fidelity Brokerage Services, LLC, member NYSE SIPC. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.